Hello, everyone, and welcome back to the J22 Report. I'm your host, Johnnie Market. You all know that drill. Smash that like button, subscribe if you already haven't. And today I'll be joined by a guest. I interviewed him at my old company 10 years ago. I decided to have him on. He has a good, he is, uh, th- he's a newsletter writer and author, and one of the very good value investors out there right now, Sean Hyman. Thanks for coming on.
Yeah, you today.
All right, great. So I was going to say, first thing, when people talk about value investing, they talk about Benjamin Graham. What comes to mind with me is a valuation. And of course, there's the godfather of value, Buffett. So first thing is, what are the type of valuations do you prefer to use?
Yeah, so you can get really complex with value investing, and I just like to keep it all really simple. So read the Graham books, I've read all the Buffett stuff, Sir John Templeton, other ones, you name it. But really, when it comes down to it, I just keep it boiled down to a handful of metrics that I know that I can count on. So one, I start off with market cap. Not that that's the end all be all, but I like usually like mid to large size companies just because just simply they're harder to take out in bad times. So we tend to stay in the bigger, mega cap, large cap, occasionally mid cap companies, and typically avoid the micro cap and some of the small stuff. So market cap size, we go to obviously earnings. We want to see billions of dollars in earnings, and the amount of billions is relative to the size of the company. But we want to see that there because, again, just quite simply in plain English, more billions made versus shallower earnings. You're just harder to take out in bad times. So we're trying to determine how solid you are and how hard you are to take out. And then, of course, we go to cash. Cash on the books is huge. When you're out of cash, you're done. And so the more cash they have on the books, the better. The more stable it is, the more that they can access everything they need to, and not have to be nickel and diamond everything through the tougher times. Matter of fact, sometimes they can even pick up other companies on the cheap when these bad times do emerge, because they're still there and thriving when the others, their competitors, are on their last leg. And so we want to see billions of dollars there in cash. And again, that'll be relative to the size of the company as well. So some will look for more billions than others. And then, of course, we look for debt that is no more than 50% of their market cap, but ideally about 33% of their market cap. So we don't see debt necessarily as bad. Obviously, when people think of debt, like commercial consumer debt, of course, obviously that's bad, charging things on credit cards and buying clothes and food and consumables and things of that sort. But when you're, buying something to get better prices on your inventory, or to expand your business, or to lower your costs and to widen your margins using that or something like that, of course, it can be very productive. So we don't have a problem with debt as long as it's not at unhealthy levels. So these days, sometimes you'll see, debts that are 80%, 100%, 120% or more of market cap. And to me, that's just too high risk of a deal, just to service that debt. If you get into bad times or prolonged bad times, that could end up being the undoing of a company. So we look for how solid a company is by those simple metrics. And then once those boxes are checked, we look for PE ratios, trailing and especially forward price earnings ratios to see, because we want to buy something on the cheap, which is usually when it's hated. Nobody's loving it. Nobody's giving it props in the news media. If anything, they're usually dogging it. But when I look at it, the fundamental balance sheet looks good. The valuations look good. And so it checks all those boxes, and we'll get into it. So usually the things that we'll be getting into, nobody's giving it props on CNBC or Bloomberg. Nobody's talking about it in a favorable way in Fox Business. These are things that people think you're crazy for getting in, but it's because they don't know the balance sheet. They just know what's been said on TV about it, and so they're just led forth by that. So we're very much contrarian in that way. So we look for how solid it is and then how cheap it is. Has to check both of those boxes. And then once it does, that tells us we got the green light to enter it. And then from there, we add on other technical analysis type of things, other sentiment indications, and so forth, to help us, tranche into it. to kind of average down, like you'll see Warren Buffett do a lot. And that's why he'll say sometimes I like it when my stocks go down. And people think, why the heck would he say I like it when my stocks go down? Well, he liked it and he felt like it was a value at this price, and the market took it unusually lower, which is not uncommon. And so he's able to buy more of it and lower his break-even price, lift his average blended dividend yield, and he's loving it because he has a lower bar to hop over for break-even. He's got a lower valuation, lower PE. He's got higher dividend yield. He's loving that company. So those are the ways that we look for a company once it's checking all those boxes first. And if it checks all that, then on to some technicals and sentiment to kind of tweak some of our entries.
Yeah, definitely. I generally look at sentiment. I actually, ironically, I don't really use CNN much, but now I actually look at their fear greed index
Yep, I
to
like
know if
that.
there's some type of correction coming. One thing about your medium to larger caps thing is one thing that avoids is fraud. Because you get in the junior
Right.
section, I can speak for mining. Sometimes there's absolutely no resource. They pretend and they don't really care because they're hoping to get bought out. And if it's not bought out, then they're hoping they can raise money, and
Yep.
that investor's the sucker, not them. So you do get medium and big size. So in terms of using that strategy, what I would say, you talked about gold and silver in our emails. What are your opinions of them right now?
Yeah, so while I'm not a gold bug or a silver bug, meaning every day is a day to buy gold or silver, I do think there's times to buy and own almost any asset as long as it's quality, and a time to not own almost any asset, even something like gold or silver. And that's where you would get a lot of people that would differ from you, like, oh, you should always own some gold or silver. But to me, gold and silver, they get in booms and busts just like anything else. And so there's times where they'll go through multi-year downtrends, and there's times where they will skyrocket and they'll go to the moon and get in bubbles, particularly in the final stage of a metals rally, and that's when we're easing out of one. So we are in a period where I am still bullish on both gold and silver, and we have been for a number of years. So early on, when I used to run the Ultimate Wealth Report for Newsmax, we were in so GLD and SLV and even PPLT. So the ETFs of the metals, and that was back in like 2015, 16, 17, when things were very suppressed, very low. Nobody liked them. Those metals were on the out. They weren't popular. Nobody thought it was the right move to make, but yet things just looked right, from horrible sentiment, technicals and sentiment gauges and things of that sort looked right to me to be entering in. So we've literally been involved with it since then. We rode some stages of the SLV PPLT. We sold off all that later upon in later years when there was some pullbacks. We went then into the miners through GDX and SIL, and we've been writing that up in my present newsletter, The Logical Investor at logicalinvestor.net. And we're doing well on those. And I think there's more to go in those. So we have avoided, like you say, some of the smaller ones. So I really don't necessarily gravitate towards GDXJ, the juniors or something of that sort. Nothing wrong with that necessarily, but it is an extra layer of risk that I'm not necessarily comfortable with. I want to stick with the big guys. And so while we have owned some individual gold miners in the past, it's usually the biggest of big. This time around, we're in the ETF and a little bit of a broad spectrum bet, if you will, on metals rising and miners catching up over time. So we believe that the miners have more of a run percentage wise ahead of them than the metals themselves actually do. Now, I think silver itself has still a lot of a percentage rise run, even a lot more so obviously than gold, but I still think SIL probably outdoes it percentage wise also.
Yeah, I've been in gold and silver for a long time. I feel like I know that market so well. In terms of you were talking about boom bust and everything, I would say, would you agree with this or not, or some would agree? Is like I always think it's important to follow the really uh I call them crap juniors. They could be just smaller or market caps because what I learned from the 2011 market, if you want to know when the time to unload a lot of them is when you see stocks that are trading at a couple of years ago, 20 cents, 40 cents, when they're three, four, $5, that's a time to get rid of. Lighten the load at least, or at least hedge, in my opinion. What do you think?
Yeah. So, I mean, we've avoided the juniors. I think there was one time in the past where I was in like GDXJ, but for the most part, I've always avoided the smaller ones, always stayed towards the larger ones. And if I've got a forte, it's like in spotting and exiting out of bubbles in a good fashion. And so I've got some indicators and things that I use to do that. But as a bubble is just going crazy, we start slowly easing out of positions, and that way we probably will be out before bubble tops and maybe miss a little on the top, but we're certainly not there for any of the downside. And if by chance we got caught in some early downside, we will have already lightened up our position to such an extent that it really goes down on us much less than the ride up. And so we manage a lot of risk that way when we see things getting into a bubble. And all that do get into a bubble. Gold gets into them, silver gets into them. It's been a long time since they have, but silver was there last time at 48-50 bucks, and gold when it first hit a thousand or so or whatever, and went on back down. So we've avoided them when everybody thinks it's sexy and cool, and that's what we're not buying. We might be holding, but we're not buying then. And if anything, we're looking at closer to exiting during those times. So it's really the be fearful when others are greedy, greedy when others are fearful, Buffett concept there.
Yeah, my target on gold is I've been consistent with the channel is that 3,000. Once it hits there, the only thing that should be in your mind is lightening the load or a
Yep.
exit strategy. I'm not saying I know the exact price, but
Right.
also, as you said, if you see it on CNBC, maybe that's a time. You also
Starts
do.
getting more mainstream. Yep.
Yeah, definitely. I was gonna say you also do. I just wanted your thoughts on foreign currencies. Which ones do you like? Which ones are expensive in your opinion?
Yeah, so with foreign currencies, unlike a stock, you can't just say like, oh, it's got a PE or a this or that to like value it. So fundamentally, I really don't assess a currency. So to me, currencies are all long-term fundamentals and long-term sentiment type of things. So and we've had good fortune in that through the years. And with currencies, sometimes you do have to be a bit more patient because their turnaround times are a little bit longer. They slower, and so they're not going to be quite like the move of a stock typically. But the dollar's been rallying overall against a number of currencies ever since like 08, 09, especially like against the euro, for instance. And so the euro's been pummeled all that time. The yen's been pummeled. Dollar yen has been through the roof on yen weakness, dollar strength. And I believe we have gotten bullish on the euro as a result of that. We've gotten bullish on the yen as a result of that. Also, too, sometimes the yen can have a propensity to act as a defensive mechanism in bad times when markets are going down and there's a off type of scenario in markets. The yen can tend to get a boost from that, and so as people move out of more risk on currencies and move towards risk off currencies, or just simply unwind their bullish positions that they had, would be to selling out the higher yielding currency and to buy the lower yielding one to cover and to close and to flatten. And either way, that can boost things like the defensive yen. Now, I used to be the same way on the Swiss franc, but they have pulled some crazy moves out of their hat and really punished forex investors and traders and stuff like that, and a couple of times through the years. So really, I pretty much avoid it, even though I'm somewhat bullish on it in general as well. And we really stick with the yen. So in our stock service in logicalinvestor.net, for instance, we're in FXY. So we just take the ETF unlevered, and we're bullish on that, and we're looking to see that go higher over time because we believe dollar yen is going to come down from 160-ish or so to down to 120, 130 or so at least over time, and that it'll give us a great return taking FXY from where it is now up to maybe $90 a share over time. And we're comfortable if that takes 2 or 3 years to get there on that. Again, it is an investment on that. It's not really like a trade. We're not looking for that quick buck in it. We're looking for that long trend, which currencies are really good about doing. So they tend to, once they get in a direction for a while, they tend to stay there for many, many, many years, and then reverse once that has been so extreme, and then go in the other direction for many, many, many years. And so I think that we're probably on the cusp of one of those. And the yen probably is likely to turn around first if I was a betting man, and then the euro, potentially next after that.
Yeah, so quick question. I was just always curious. I follow currency markets, but how do you like invest in it? Is it like a government bond or is there an index? Or because obviously you don't like buy and hold the physical currency at your place or whatnot.
Yeah. So back in the day when I was in the forex market, we would just trade euro USD or dollar yen or whatever, and we would trade the currency pair and hold it. And it's highly leveraged, but we would take it on a very small level relative to our size of our
Like
account,
by
so
the
we could handle the
futures?
big fluctuations. Now, it was actually in the spot forex market.
Oh, okay.
But these days in the newsletter, we pretty much trade everything through a stock market related instrument. So these days it's like excuse me, it's like buying FXE for the euro, it's buying FXY for the yen, and doing it that way, because anybody can do that through their stock trading account. And so that's the way that we take those positions on. And just you just have to give them time, because those are not necessarily fast growers, they're slower growers. But you're in a time where most assets of the world are grossly overvalued, and so there's very few values out there to be had. I mean, we hold like 20 positions in our stock portfolio, including some currency and commodity type positions and things like that, all through ETFs or stocks. But it was a miracle, honestly, that we found that many in this time. Now, a few years from now, when things get slammed and they're drastically lower, I can probably throw a dart and hit one pretty easy. But there's not been many values out there to be had for a long time, and I've hunted and we found what I believe are the few out there, and some of these currencies are some of those, in my opinion. So I believe you're going to see a dollar turnaround in time, which will boost the euro. It will boost the yen. Even markets just tanking quite a bit can boost the yen alone. And concerning metals, a lot of times people look at metals as just an anti-dollar play, but really the dollar has been strong the last few years, while metals have been running up. And so there are periods of time where metals can actually run up with a strong dollar. And people think that that necessarily can't happen, but there are periods of time where that happens. Now, it doesn't happen over decades like that. They do operate very inversely to each other, but over short periods of time, a year or two or three, that can happen to where you can have strong gold, and that's what we've seen here recently. So, but I think the dollar situation is more due to reverse. Metals obviously eventually top out. Like so my projections took what I felt like was a safe projection all the way up to about the 2,800 3,000 level on gold, and from there, who knows? It's like the last big run up that happened in gold went from like 700 to like 1,900 or something like that, or whatever. And it that last leg was just crazy parabolic and crazy strong. So it's always hard, like nobody's going to like ring the bell at the top on gold, but at least we started getting into it in 1,000, 1,200, whatever, and here we are close to 3,000. I felt like that was a good safe run, and then from there it starts to become a lot more speculative as to how much higher that goes. I wouldn't argue if somebody says, oh, it can go 3,300, 3,500, whatever, but I just feel like the 2,800, 3,000 target was a pretty safe target. And from there, it starts getting a lot more touch and go on that. So that's why we like the miners a lot better, because we feel like there's more upside there. Again, I do think silver has a good bit of a run. I think silver could make another run at 50 again. And I mean, 50 today is not like the 48.50 that it hit a long time ago. So I mean, it could easily go back there, and would be no big deal for that to happen. But with that happening, those silver miners should do even better.
Yeah, I definitely see that. Like Me personally, I've just been consistent. I agree with you. I think it'll go to 50. My scenario is I think either one or two things will happen. I think it will either break 50 and then there'll be like a blow off top where it goes to like 150 or something,
Sure.
or it doesn't break 50, then it will go back down. And then I would say 5 to 8 years later, it will revisit because the first time went to 50 was like 1980. And then the next was 2011.
Yep.
And then if it goes to 50 this year, you can see the times having. So
Yep.
then, like, that's my scenario. But like what you said back on the gold and the dollar, I always say correlations are a good thing to notice, but they have to remember correlations date, in my opinion, but they don't marry each other.
That's right. That's right.
Yeah, and yeah, as you talked about, I think in the 2000s, if you remember differently, let me know. Like the dollar would just go down, and then in '08 it spiked up while gold went up. And
Hmm.
now there are times where they're going together.
Yep. Absolutely, and it can happen, and there's some people out there that just believe the dollar always goes opposite of gold, and over a long period of time they are absolutely right. But there are periods where you can get a year or two or three or whatever where they can actually both head in the same direction. So yes, gold does have its biggest heyday when the dollar is heading down. It's like it's got its wind to its back, and that further aids it, of course. But it is something, and to me, my eyebrow raises a lot when you do see gold heading higher when the dollar is heading higher as well. It shows you there's a lot of bona fide gold buying, and you can't just blame that on the dollar being weak. That's like literally a strong gold. And when gold is picking up and silver is picking up and these miners are picking up and these indexes are at nosebleed levels, it is, in my opinion, a big warning sign for the stock market and probably the economy as well.
Yeah. Well, the other thing too is like gold and oil used to go up a lot.
Mm-hmm.
2000s and in '08, oil made an all-time high of around like 145. Gold was, but now recently, even though gold's approaching 3,000, oil's nowhere near. It's not even near 95 anymore.
Yeah.
So that's another loosely correlation that has been broken. And the other reason I bring up oil is I know you talked about the energy market,
Mm-hmm.
and I was just wondering what sectors you like, dislike, what are you thinking about there?
So, so we do have one oil stock, but we also have we've got some tranches that are quite a bit lower. If oil were to get slammed, then we can get better pricing in our oil stock. So we've got EQ&R, and we're bullish on it. It looked the best, on its chart and its fundamentals and its valuation relative to a lot, because there was a lot of oil stocks I still felt were a little bit too high, too lofty. They weren't the right places I wanted to see them at, and so I felt like this was more of a conservative measure, and so we took a position in it. And oil is as oil went up and then came down and has been consolidating in a kind of a wide volatile range for a while. And if Trump gets his way, it could break oil a bit lower before it ever comes back. That may happen, that may not happen. But if it does, then we go, great. We get some more tranches into a stock we already love, lower PEs, higher blended dividend yield, a fuller position, and it goes higher. Or if that does not materialize, then and you start seeing oil come off of its lows and go material higher, then great. What we've already got in it goes higher and we get a quicker profit. So that's the way that we look at it, rather than having to say which way will it go, because that is probably the toughest call is in oil, whether it goes, because I could see cases for for both sides. And then you've got all kinds of scenarios with tariffs, with Trump possibly jacking with Iran right now, with wars, whether they continue on, whether they cease. I mean, there's all these dynamics that are out there, with Russia, Ukraine, et cetera, that that there's a lot of moving parts to that could necessarily take oil either way. So that's why we like to play it through that oil stock. One, at least I can tell you, it's a solid company. It's cheap valuations, got a great dividend. We've got a plan of attack for if it goes lower. And if it just goes higher from here for some reason and defies everything, then we've got a leg in and we can enjoy the profits in that.
Yeah, oil can be tough because when you look at the fundamentals, everyone thinks drilling, drilling, but people forget one of the reasons oil went down, I would say 2 years ago, was the height is releasing the SPR. So it's possible
Yeah.
you could ramp up drilling, but all that oil that was being dumped on by the market, where it's by, well, Joe's gone now, but
Yep.
where it's by him or another government, that comes off on the meantime, and that comes off a lot faster than the ramp up in production. So you can be increasing production and the prices go up. And sometimes the production doesn't really come into the market till 3 years down the road. So, and
It's true.
Saudi, go ahead.
And the thing I think too that really hasn't been advertised a lot in the media because people think, okay, Trump was in office, so it was drill baby drill, and there was a ton of production. And then when Biden got in office, he's Mr. Green and doesn't like oil, so then oil production would go down. However, it did not. Like oil production was like 13.5 million barrels a day being pumped out in the U.S. Now, the media had no probably incentive from the Biden administration to cover that because they didn't want to promote that we're pumping tons of oil in a green society that he's trying to make, right? Green that's not really green, but um, and so we were already pumping a ton of oil already. So yes, Trump comes back in and says, drill, baby, drill. But the question is, how much more production can we bring on and handle? So we're already at like 13.5 million barrels, and that's at some of the higher side that we've ever been. So I'm not saying it's impossible to go higher, but it's not like taking a car from 60 to its top speed. It might be like taking a car that's already going like 80% or 90% of its top speed and just further pressing the pedal down to the metal and getting you to your top speed to get that extra 10% or something like that. So we definitely can get some benefit out of that probably, but probably not near to the amount that people think can be had. Plus, to what you just said too, he's got to fill up the SPR again because Biden tanked the thing trying to get oil prices down to get a few extra votes here and there. So that has come down to some pretty low levels, and Trump's going to want to get that back up for our own energy security. So there's a lot of dynamics there for sure.
And that creates buying power in the markets, and generally
Yeah.
buying pushes prices up. So sometimes things take a turn the opposite way, and what you think would happen doesn't happen till like the fracking. That didn't come until a lot of that investment was done in the early 2000s, and that didn't come on until next decade.
Yep.
And that's
Absolutely.
the other thing. So right now, I guess one other thing I wanted to get into was just the general stock market. What are your opinions? What are your thoughts on it? Where do you see it going? You can do short or long term, or just one if that's what you're sure of.
Yeah. So, of course, ultra short term market can do anything, right? Just because it's
Yeah.
very irrational when in environments like this. But I think it's in my opinion, very safe to say, in my opinion, that over time, markets are like in a bubble territory. They're overvalued, even if you don't say they're in a bubble. PEs of like 25 to 30 on the S&P, depending on what news source you look at. Um, and that's just been historically on the high side. I mean, that's like double of what the median or mean is, for the market. So to me, and then when you see the run after tech stocks, the run after AI, the run after the metaverse that had happened, the throwing the money at NFTs, there's just a lot of sloppy throwing of money out in this period at all kinds of stuff, like throwing a lot of money out at stuff and seeing what sticks. And to me, that so reminds me of the bubble of 2000, the internet and tech bubble, where things were going through the roof, and Nasdaq was 3,000, 4,000, 5,000, and it was going to the moon, and people were going to tell their bosses they could kiss off, and they were just going to stay home and trade. And I mean, like there was just it was a crazy period of valuations, of over bullishness, and the sentiment and the way it was. And to me, we are some version of that today again. And in my opinion, that is happening because you've got a new generation of investors largely who have not traded or invested through that bubble, so they don't have any remembrance of that being in 99 2000 as we sit here in 2025. So I'm old enough, I'm 55, to have been through both of those. But so lived through it, was a broker through it, talked to broker friends through it, talked to client base through it, 80 or 100 calls a day. You get a huge assessment of the euphoria and the feel out there. And to me, we're back in those days, where to me the euphoria is like in Bitcoin and some of the AI stocks and some of the quantum computing stocks and even some of the old, the Metas, the Amazons, all that. And a lot of them are even way overdone. Google's, et cetera. They're great businesses. They'll be around tomorrow. They're not going to fail, but it doesn't mean that they can't bust a ton. Like Amazon was rock solid as far as kind of having an island unto itself in the early stages of online book selling and internet selling and all kinds of stuff like that. It didn't have a ton of competition, and it had run up a good bit, and it got slammed hard in that crash. And there's some others that got slammed hard, and so people say, well, technology is the future. That's true, but Cisco still collapsed and went down to an insanely low level. Nasdaq, tech stocks still went from 5,000 something to like 1,100 on the index 2 or 3 years later. And so while these things may be true, it doesn't mean they have to anywhere near hold their valuations or levels that they're at today. And even if a technology is for the future, they all don't survive, whether you're talking the old days of radio or cars, or whether you're talking the more modern days
.com.
of AI or what have you. It's like, yes, there will be something that probably survives, but it may not always be who you think it is. And a lot of these people who even made a lot of money in the bubbles cashed out in the bubbles and didn't ride the bubbles down, like the Mark Cubans of the broadcast.com, things of that sort, where when things got frothy, they started cashing out quite a bit. And you're seeing the CEO of NVIDIA doing the same thing. I mean, he's taking regular cash outs all the time. And I'm sure some of it's for estate planning and whatever typical stuff or whatever. But in his heart, he's got to know this thing's in a bubble and the party may not last forever. And yes, they've probably got a great place in the future and their technologies are probably great, but their pricing is like pricing just everything to perfection, and one false move and that can collapse quite a bit. Honestly, even Nvidia here lately has been hanging out a lot around 118, 120, 122, which is back around that split level. And so a lot of people who bought the split thinking they're going to get rich overnight and this is going to be their retirement and all that, these people are flirting with them being underwater. And if it starts to go material under that, you're going to have a big crowd that's stuck way up at the top that's got to hit the sell button in mass, and it can cause a massive avalanche over time.
Yeah. Well, before we go, I guess I'll say two things. You just said it. CEO selling a lot, and Pelosi also sold on December 31st, so
Yeah,
that doesn't give me a warm, fuzzy feeling. But if
you're smart.
any, yeah, if anyone wants to find out more about you, subscribe to your newsletter, how can they do so?
Yeah, so I've got a newsletter, logicalinvestor.net. So it's a value investing newsletter. So we do take positions over usually 1 to 4 years time, depending on what we're in, reaping a good bit of dividend income through many of those positions in that time as well. So that's my investing service, Logical Investor. Then I've also got a trading service, a stock trading service where our goal is to be in it a year or less. So it's more swing trading. It's not day trading. You're not stuck to your screen all day, that sort of thing. And then I've also got an options trading service where we typically buy into like leaps, so long-term options, and we're into those for like, many, many months typically. Sometimes, we're fortunate we're out in weeks or a month or whatever, but we tend to take a long approach to the option market as well, just like we take a long approach to the trading market, because that's where it's easier to make money in those markets. The whole ultra short term stuff is where all the competition's at. It's where all the money's put into the systems. It's where the direct lines go to the exchanges. It's where all the MIT grads are at. It's so all the competition is down there. So So fighting at that end of the market is like fighting with one hand behind your back, and you're trying to fight Mike Tyson or Vander Holyfield back in the day or whatever. And it's just to me it's the tough thing to do. So we've got investing service and two trading services that may interest a lot of people. And then, of course, in the coming months, I'll have a mastermind that I'll add to that as well, where I teach people a lot about life, including the financial piece of life and how that financial piece affects all of those areas of life as well.
Great. So, yeah, thank you for coming on. I'll have you back on. And I forgot to say this in the beginning, but I always say in the beginning generally, but always read the disclaimer below. We're just talking about markets. We're not giving financial advice. So,
Yep.
thanks for coming on, and I will hopefully you'll be on again.